Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, with my co-host Brian London. We have today Gerardo del Real. He is the co-founder of Digest Publishing and the co-owner of Resource Stock Digest. A lot of experience in the field. He writes free editorials plus 3 paid newsletters. Gerardo, so much going on. I mean, we're just coming off the sell-off, to be frank, so my head is exploding from a lot of action. But you have a great deal of, let's say, expertise, not only in gold, but in copper, lithium, various metals. Why don't you start us off with what is most intriguing you right now, right? In this very tumultuous time, where are you most attracted?
Well, first off, thank you so much for the opportunity. Thanks to you and to Brian. And, sell-off. What sell-off, Fergus? This was so 24 hours ago. We made it all back, right? I mean, the weather changed 2-3 degrees yesterday, and it's back up 2 or 3 degrees. And so I think that's a great starting point for our conversation today. Look, we have a move in the 10-year yield that I think is extremely important right now. I think it's a pivotal moment here in the next 30 days that's going to be very consequential for what the gold price does, because if you look at a correlation over the past several years, it's intimately correlated, the gold price with the 10-year yield. So I'm watching that like a hawk. Simultaneously, I love the pullback in the uranium equities right now. It's a pullback that I think not enough speculators are taking advantage of. I can tell you that when I was screaming and pounding the table for my readers to average down into companies like the Fission Uraniums of the world at 10 cents, the Sky Harbors of the world at 10, 11 cents. A lot of people didn't think there was ever going to be that upcycle in uranium because it's been so promoted by people like myself, right? Where the fundamentals are clear. You see the mega trend you see where it's headed, but it was taking so long to actually lift off as it related to the juniors. And I think it caught a lot of people off guard, right? Fission went from 10 cents to 65 cents in a matter of months. And then you can go right on down the list. And so I think this recent pullback is one that people should really study a little further. And you should be making a list right now and take advantage of it, because I think it's going to be short-lived.
That's a great point, Gerardo. Where do you think we've begun that long-awaited, and God knows we've been talking about it for years and years, but that seemingly inevitable, although apparently not imminent, bull market in uranium? Is this the next upcycle, or is it a cycle as we're beginning? In other words, should investors wait for a pullback or just start dipping their toes in the water right now?
I think we're, to use some baseball parlance, right? Everyone that knows me knows I'm a big Chicago Cubs fan, right? I spent my childhood in Chicago. I think we're in the bottom of the first or top of the second inning, meaning the game has started. The macro factors have been there. Sprott is coming into the market in a very consequential and significant way, with a balance sheet that, again, is going to move the spot price a little bit at a time. And you also have companies that have decided they're no longer waiting for the utilities to step off the sidelines. They're going to start building an inventory of uranium pounds, and they'll wait for that upturn because they see a lot of what we see. They see it's game on. So I think this pullback is an excellent opportunity for people that don't have exposure in the space to really start doing some homework and reaching out to the Brian Londons of the world, and going to Digest Publishing or Resource Stock Digest, and really just gathering as much information as possible, and pick the names that you like, pick the names that cater to your risk tolerance. But I think the timing is phenomenal.
Well, let's explain a bit of what you're talking about with Sprott's move into uranium. Can you explain that for our readers?
Absolutely. So the very short version is, for those that wanted, for a long time now, if you wanted exposure to physical silver, or physical gold, one of the better ways, one of the more liquid, visible ways to do that was through the Sprott physical product that they offer, right? And full disclosure, I'm biased. I've had an account with Sprott for a very long time. They've been very friendly to us. And so I like the way that they do business, but they've now launched, in essence, the uranium version of the gold and the silver product that they've been offering for years. And we saw what happened with gold and silver in the last bull run higher. The price ticked higher. The uranium space is so much more opaque and smaller that Sprott coming in with the balance sheet, right? Triple digit, millions, and going into the spot market and actually buying and building an inventory and buying pounds, I think is going to have a very material effect. And I actually do think it's going to inspire some of the utilities, which again, they're the largest consumer. They're the elephant in the room, right? To step off the sidelines and actually start contracting. And they'll do so at much higher prices because the input cost for the utilities is so inconsequential. Whether they pay 40 or 70 really isn't that big a deal to a utility company. But I can tell you in the markets that we dabble in, Brian, as you know, uranium bull markets are violent for a reason. It doesn't take much to get it going. And I think I think we're there. I do think it's game on.
Yeah, the price is made on the margin for demand, and we've been waiting so long for those long-term supply contracts to run off so that the utilities would have to get into the market and bid up the prices. Now, with Sprott being in there as another bidder, that could accelerate that factor. I think that's a great point. I'm wondering too, because Sprott's bullion trusts, they hold, they don't sell. So is this fund then, because they bought the uranium participation fund or are buying it, right? Yeah.
Correct.
So does this mean that they will at some point, when we've reached the top of the uranium price cycle, would they start selling, or are they just long only? Do you know that? I'm curious if it's structured any differently from the bullion trust.
It's structured, from my understanding of it. Let me preface it by saying that from my understanding of it, it's long only now. As with all markets, eventually they'll have to sell into the market, right? I think if we get a run as we did the last time where it went from, 10, 11 a pound to 140, 150, you have to sell into the market, right? If you have shareholders and you have a mandate, you have to do the responsible thing, and sell into that rising market. But I think it'll be, as it usually is with Sprott, it'll be structured well. It'll be into a rising market. And, there's a lot of runway between where we're at now and when that happens. And so for the equities, we're talking triple and 4-digit gains, not double digit gains, right? And so there will be a lot of warning signs before that happens and a lot of profit opportunity for it.
What are those warning signs, Gerardo? What are those warning signs that you predict will happen before we see some kind of spike?
Well, I think as with lithium,
are these proprietary?
Ago, no. This is common knowledge. I think to anybody that's been watching the space, when all the copper companies start becoming uranium companies, and all of a sudden everybody's got a uranium product to offer you, and it's all based on the same model. That'll be the start of, okay, we're getting a little top heavy, right? We're nowhere near that. Uranium is still almost universally hated as a speculative class, right? It's not until recently that we have, people that we thought would never be friends to nuclear, like Bill Gates and Warren Buffett, all of a sudden warming to that idea. Very early days, but there will definitely be signs. I mean, when everything starts percolating higher simultaneously, meaning everything is up triple digits and you don't have to be selective, a la the stock market, the major US indices here in the past 7-8 years, that's when you start being cautious. We're nowhere near that right now.
Yeah, the last uranium boom, the uraniumania that we had, we saw the uranium price get up to $140 a pound, but we also saw new uranium companies like you mentioned sprout up like mushrooms after a rainstorm. There were 400 or 500 of these junior uranium companies out there. Today, there's only about a dozen that are worth mentioning. So if we have a similar market phenomenon where all of this money is coming into the sector, instead of being spread over hundreds of companies, it's going to funnel into, at least initially, about a dozen or so companies. So that's where you get a real explosive profit potential that you're talking about.
And it's a compelling opportunity. I mean, if we look at, the venture exchange and we look at the thousands of companies that are there, to have only a little more than 2 handfuls, right? A little more than a dozen or so that are quality names in the space, receiving the bulk of that capital. And be clear, the professionals will come in and buy those names first before they spread it out to the more speculative, less quality names. I think it makes for a compelling opportunity.
What about the other yellow metal? I have a feeling.
Sorry, I think you meant gold.
It's been a bit boring over the last couple of weeks or a few weeks, but I have a feeling you share my long-term bullish enthusiasm for gold. What do you think in the near term?
I actually just turned bullish in the near term as well, Brian. I think this breakdown in the 10-year, coinciding with a higher dollar, coinciding with what looks like to me gold putting a base at around the $1,800 level. It's a powerful base when you consider that the last base that was put in was right around between 12 and 1400, right? Before we really broke out to new all-time highs. So I actually am bullish right now. And there are some names out there that are just being given away because I joked with the yawn and everybody's bored with gold. And, we get the subscriber emails similar to uranium saying we see monetary policy, we see economic policy, we see where things are headed. Why isn't gold performing better? And the simple answer is sometimes it takes a little bit of time. Everything moves in cycles. We've had a situation in the markets where we've had every alternative to gold. Frankly, for a lot of people, a lot more exciting alternatives, right? You got Dogecoins and unicorns and, all sorts of tokens that are easy to market, are not very well regulated. You have billionaires like Elon Musk tweeting about this stuff every day. And here you have gold, right? Here you have gold, just good old fashioned 5,000-year track history for preserving wealth. Doing exactly that, and people aren't satisfied with that. That's the time to buy gold. So I'm excited in the near term. And when I say near term, I mean the next quarter or so. The next 3 months, I think we'll see that new breakout. And I think we end the year. Now, by the time you and I see each other at the New Orleans Investment Conference this year, Brian, I think it's going to be an exciting crowd.
I think so too. And, personally, I think I need to see a little bit more on gold on this recovery from its June sell-off. I'm enthused by the drop in the 10-year yield. I think that has a lot to do with this Delta variant of COVID. The market, the bond market, really 3 weeks ago started to smell out more of an impact from that than anybody else thought. And everybody was wondering, well, why are yields falling? That, as it turns out, was it. The bond market kind of sniffed that out. So we're going to see, in the near future, what that ultimate impact is from the Delta variant. And I think the impact obviously is much greater overseas than it's going to be in the U.S. And that accounts for the simultaneous dollar strength that we've seen, which is so weird to see, the dollar strengthening and yields falling at the same time. While the Fed was talking about tapering and rate hikes a couple of years down the road. So seems like that's been put off at least till next year, don't you think?
Absolutely.
The tapering at least.
Oh, absolutely. I think even a conversation about the tapering has been put off for at least the next year or two. We had a member of the Fed yesterday or a couple of days ago that called himself Team Inflation. The supposedly neutral Fed board member is sitting here advocating for inflation. They're not even lying to us anymore, Brian. They're telling us exactly what that policy is going to look like. And anybody that thinks they're bluffing, you haven't been paying attention. I think when you look at what the Fed has reacted to the last several cycles, not just this go around, it's pretty clear what the policy is going to be. And so again, let's assume that gold never goes up another penny. There are some companies out there that are just absolute cash cows at current levels with solid fundamentals. So, you have to pick your risk tolerance. You have to pick your timeline. You have to pick, all of those things. It's different for everyone, but there are some deep bargains in the gold space right now.
Well, I think we'd like to get to those, but first off, what's your view on inflation? Is it transitory? Is it stickier? Is it permanent? Where along that spectrum would you lie?
I think we probably agree that monetary policy only is moving in one direction.
Yeah.
And if that is the case, and I believe that to be so, then you can't believe that inflation is transitory. not as it relates to most of the things that are affected by real inflation, right? There was an exchange with a gentleman the other day with a colleague and friend of mine where he noted that the price of lumber is suddenly down again for the last month or two. It completely ignoring the fact that the CRB just hit a 10-year high, right? Because there's 19 components to that index. And so we can all cherry pick our data and look at one thing just to be right. But I think getting it right is usually more important. And in this case, I think in most cases, inflation isn't transitory. I think it's here to stay because of how I think the debt won't be paid off. They'll inflate as much of it as they can before the market forces a reset. It's the ultimate bridge for the Fed to keep the citizenry appeased.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, I'm Brian London here with this week's CEO interview, in which we interview the CEO of one of the companies in the Inventa Capital Group. The Inventa Capital Group, of course, is the sponsor of the Gold Newsletter podcast, and we're glad to have back this week, Chris Donaldson, CEO of Outback Goldfields. Chris, you just put out an exploration update, kind of explaining, I guess, a lot of the delays that have been going on in your exploration programs because of what's going on in the fabled Victoria goldfields in Australia. Can you bring us up to speed a bit on what that exploration update gave to the public?
Yeah, sure. Thanks, Brian, for having me back on. A couple months ago when I was last on, I was all excited about our, ramping up our program and on our 4 properties that we have in and around the Fosterville mine in Victoria. Of course, this area is as exciting as any gold exploration area in the world right now. And we're starting to see some really good hits that have come out. E79, a couple other companies, Mandalay Resources, and recently Fosterville South had some really good discoveries, and so they're getting sniffs that maybe there are other Fosterville style deposits out there. So I was quite excited last time I was on about all the things we had planned. But out of our control, Victoria had some outbreaks of COVID, they shut down. And for us at our stage, a big part of what we do is getting land access, and it's challenging when you can't go and shake a farmer's hand to ask them if we can poke around on their fields and that. So that's been was delayed the last maybe 6 weeks or so. And some of our assays, as people are from the assay lab are working at home and teaching their kids again at home, just delayed things. So, we had to pivot a little bit, and went to a huge sampling program across 3 of the 4 properties that we have. This is work that we need to do anyways. This is stuff that is still very important. And as we try to identify, the targets that we have a very large land package. So we do have to narrow it down and then start to rank and prioritize here. So yeah, last 6 weeks have been a bit slow. And as you know, maybe the timing wasn't bad because the markets haven't been great either. But the restrictions are easing and we expect to start ramping up here, maybe as early as next week. And the ramping up, will focus primarily on our Ewan property. And I've talked about this before. We're kind of two different targets in that area. The prime one for us is around the Golden Jacket mine. This is a historic mine that had produced, had 250 gram per ton. And we've done a lot of sampling in the area. We did the mag survey and a Lidar survey and have now plotted out a RAB program, a RAB drilling program, which will be about 300 or so holes in and around the Golden Jacket mine in a grid. And we're also going to poke a few diamond drill holes underneath to better understand the structure and maybe get lucky if we hit something right under the mine. So.
Yeah, that mine is very interesting to me because of the just tremendous grades that produce, the average grades that produce in that area. And these LiDAR surveys are tremendously helpful in finding old workings. And of course, that's the best sign of where you can find gold today is where somebody found it previously and weren't able to extract it, or were only able to extract it at grades far, far higher than the average grades today. So I guess that Lidar survey uncovered a few tantalizing new targets for you.
Yeah, I mean, you got to remember this area was hot from the 1850s to 1920s, and made Australia the richest country in the world. And it was these miners that were coming in and chasing the alluvial gold. And so when you look from above, often it's under tree cover now, and you can't see some of the old trenching and mine works that were there. And these Lidar surveys, and we'll have some up on our website here shortly. Pretty astounding what you can see and the historic workings and how they've been trailing these old gold systems there. So and of course, if you take a step back and see what happened there, so they were mining at or near surface, and then they would hit cover or a water table. And what is being learned in the area now is, underneath these, there has to be some kind of source for that gold. And, with modern techniques and so forth, we're able to get below cover and hopefully find the source for that gold. And thankfully there's been some success this year. There's $200 million of exploration going into the ground this year. So we expect more, results coming in, and hopefully, we're part of one of the good results that come up.
Yeah. And to set the table a bit too, the Victoria goldfields are historically one of the most spectacular goldfields in world history, if not the most spectacular. And you've got a tremendous property position right in the middle of it, and we're able to do that, secure that with your contacts in Australia, your group's contacts. So, that's the initial reason why I became a shareholder in the company and was really attracted to it. The team, the property position, a way to get into the biggest area play, probably in the world, at a fairly late and established stage. It's like going back in time to get that kind of a land position. So I was very attracted to it then at much higher price levels than we're at today. And to kind of spell out the opportunity now for people this is a company that very smart people were putting a lot of money into at far higher levels, but you've been kind of victimized by exogenous events, the malaise in the broader market, which has taken just about every junior mining company out there down a few pegs, but also the complete lockdown in Victoria, which is a logjam, an artificial logjam in your efforts and your exploration efforts that's really about to be broken through, I would say, probably within the next couple of weeks, and resulting in a price that has to be regarded as an extraordinary bargain right now.
Yeah, I certainly think so. There's no real reason we should have gone down 40% here in a month, on no news. We've got ample money in the bank to finish out a pretty robust program for the balance of the year. We're getting, we're in the next couple of weeks, we'll be active again, which should give us a good steady news flow, coming into the fall. And of course, we're hoping for a bit of a gold price tailwind, and that should help us snap back and get back to more reasonable levels. So I was buying some shares here a couple of weeks ago, and I know a few people who know the story quite well are taking a position, and we've kind of seem to be accumulating in the just above the 30-cent level here for the last little while, and I hope and expect with some good news and more activity here, we'll rebound pretty nicely.
Yeah, and I think that is the bottom line. You went down on no news, and as we know, news flow is the lifeblood of a junior exploration company. So it was no news, and that situation is about to be cured in the weeks just ahead. So on the clearance rack, on the bargain rack, on sale while it lasts, with a lot of news coming up. And again, your exploration update was across 4 really great projects that we're going to see a lot of news coming up on, in just the weeks ahead. So very exciting as a shareholder. And, Chris, really appreciate your update today. Thanks so much.
Anytime. Thanks, Brian.
So if you mentioned the Great Reset, or a reset? What are you talking about there?
I think that if we look at the balance sheet globally, when we look at corporate debt, when we look at negative yielding debt, when we look at the deficit here in the US, when we look at the proposals by the Biden administration, right? We're not looking to shore that up. We're not looking to, batten down the hatch and all of a sudden get our house in order. We're looking to expand that by trillions and trillions of dollars. There is no way that that can continue at that pace. And I do believe it'll continue at that pace and not simultaneously get inflation. And then we're dealing with the Fed. This isn't Volcker back in the 80s willing to ramp rates up to 17, 18%. This is J&J. This is Janet Yellen and Jerome Powell, who are telling you that all they want to do is get inflation hotter. And again, we have board members, team inflation. So when we look at all those things and connect the dots, I think the Fed thinks it's figured out that its bridge to keep people appeased and arguing with each other over insignificant things is to just keep printing money. I think the Biden administration has figured out, or thinks they figured out, that the easiest way to keep people looking the other way is to keep sending people checks, as opposed to saying, no. Again, we got to get our house in order. Getting our house in order is not in the cards. And so if you believe all those things, and I do, it seems like a pretty simple conclusion from my vantage point.
Yeah, it seems like the Fed wants inflation, obviously, and actually needs inflation because they need to depreciate the value of the debt, and they need to get some breathing room on inflation so that they can raise rates above zero. Otherwise, they can't cut rates in the next inevitable downturn, and repeat the cycle, wash, rinse, and repeat. But it's also obvious that they think they can control it at some reasonable level, maybe 3% for a couple of years, or maybe 4% that would allow them to raise rates to 2 or 3%. In that kind of a scenario, always behind the rate of inflation because they need negative real rates to keep the economy going, to keep the debt from spiraling out of control. What do you think the odds are that they can keep that genie's foot in the bottle once it's gotten that far out?
It depends on which genie you think is in the bottle, Brian. I mean, we started this by talking about a monetary reset. And what I meant by that is I think there's going to be debt implosions globally that are going to be satisfied the way that traditionally they've always been satisfied, by resetting the currency, by coming together on a new agreement, except this time it involves the dollar, right? Which is the currency that everything is pretty much measured by. And so I think we have a Bretton Woods type agreement that leads to a new reset where everybody comes together, because I just don't see a way out. You mentioned the genie in the bottle. I don't see that genie coming out and just doing what everyone hopes it's going to do. Markets never function that way. We can look back at the history of markets in any commodity class, any asset class. There's always a black swan, and the markets aren't going to play nice just because J&J want the markets to play nice.
So what is that new Bretton Woods? Does it involve gold again, or some basket of commodities, SDRs?
That's a great question, and it's above my pay grade. Because I feel that individuals like yourself, Brian, have more common sense than the folks that are running the Fed, right? When I hear Danielle DiMartino Booth speak, for example, who will be at the New Orleans conference this fall, this is someone who was an insider. This is someone that has been privy to the mechanics of how the Fed works. And without putting words in her mouth, she doesn't believe that the Fed has control. And so when I look at someone as informed as her, who knows the ins and outs and leans so factually, not opinionated, so factually in that direction, I tend to listen. If there's one thing I've learned in life is that, one, I'm not a geologist, so I call geologists when I have geology questions, right? I'm not a banker, so when I have a banking question, I call bankers. And when I have questions about Fed policy and things of that nature, I look to the people that truly understand the mechanics of it. And everyone that I speak with or listen to is of the opinion that they won't be able to keep control of it. It's ultimately a game of trust. It's what the dollar is. It's a promise. And we've seen how that promise has delivered as far as purchasing power goes over the past century. It's been, right? While stocks and financial assets go. And I hate to make it that simple, but sometimes it really is that simple, which is why I'm confident about the price of gold, copper, lithium, uranium. It's why I bought additional real estate a couple of years ago here in Texas, just outside of Austin, Texas. And now, housing prices here are appreciating 50% year over year. We talk about 3% inflation. That's the target. That's the official target. Mm-hmm. It excludes so many things, and it excludes all of the hotspots like the Austin, Texas of the world that are running rampant hot, and we're nowhere near tapering.
Yeah, this time is the same as it has been throughout human history, but it is different in that it's global. So there's not one currency that can depreciate against all of the other currencies. So you don't solve the dollar's problem because every other currency is going to depreciate, race down to the bottom of the hill. So you do have the potential that the Fed and all of the other central banks lose control in that they can't control interest rates. That's where they would lose control is being able to drop interest rates, but the market instead saying, no, there's too much risk out there. We are not going to buy your paper at anything less than this interest rate to account for the risk because of rising inflation or whatever. Now, that may be in the short term actually bearish for gold because rates would go up higher, but that would accelerate the debt bomb from going off. The U.S. federal debt would be completely unaffordable at anything over, say, 3% Fed funds rate, and the whole budget would essentially crater, and that would force a major devaluation in the dollar. I think the markets would sense that, even though rates would be rising and the Fed wouldn't be able to control it. I think gold would soar because the end game at that point would be fairly obvious.
I think the first part of your point, Brian, is the most probable one, actually, because there isn't a currency to look to, right? The reserve currency is in as big a trouble. Maybe later in the game, maybe later in the cycle, maybe it has an extra few years, but I think it's in the same kind of trouble that a lot of these other countries are in. And so on your second point about gold actually, possibly facing, some headwinds as a result of that, I think the capital flight that the market would sniff out prior to that happening would actually lead into the purchasing of some gold by central banks around the world in an attempt to somehow come out a little bit cleaner on the other side of that reset. So I actually view it as a bullish potential catalyst for gold because of the capital flight that I think would come into, gold. And actually, and this won't make me popular with a lot of you, but I actually think the U.S. indices would benefit from that because of the rule of law here in the U.S., because we have dividend paying blue chip stocks that could still yield you 2 or 3%. And in the middle of a bond blow up or a fiasco, where else are you going to go? Where else are you going to go?
Yeah, there is no alternative. You're talking about, or we're talking about the longer term picture. And one of my big points has been it's nobody, although a lot of people try every day on Twitter and and in their newsletters, et cetera, to chart out precisely the path that lies ahead. Nobody really knows. All I really can be confident in is you're going to want to own gold and silver as we go into all of this. But so you're more bullish in the short term. One of the things that has me kind of second guessing my caution right now is the fact that we are entering that kind of typical seasonality where we're going to have gold strength going into the fall. How big of a factor do you think that is right now?
To be truthful, Brian, I am more focused now on companies that have gold exposure that don't require a higher gold price. And even then, let's be absolutely clear and transparent to everybody that's listening, right? Even that has been a losing proposition mostly for the last couple of months, right? There's producers that are cash cows that are making, money hand over fist that are down 30 or 40% in the last several months because of that weakness. Do I think that seasonality moving forward is beneficial? Sure, but I'd rather not rely on that. I would much rather make picks that I think have exploration catalyst, M&A catalyst, or production margin catalyst that I think would be significant enough to help offset any potential weakness or a lack of interest in the gold space. And then if I do get, the $200, $300, $400 move higher in the gold price, phenomenal. Then I look smarter than I actually am. But I'd rather not rely on that.
Okay. Well, you served it up on a silver platter then. Do you have any names that you'd like to share with us?
Absolutely. I think the first one would have to be Magna Gold. Magna Gold is run by a gentleman named Arturo Bonillas, who I met several years ago. And one of our initial conversations when we participated in a financing very early on with Magna, he said, Gerardo, in 2 years, I'm going to be producing. I am going to be on the M&A trail. I am going to be exploring multiple properties, and I have an asset that I think can provide all of that. And I looked at him. I said, you're going to do all this in 2 years? We have companies that have been in a permitting process for 10, 11 years, right? Can't figure it out. And he said, that's the goal. And here we are 2 years later, and they bought the San Francisco mine for a song. They've drastically reduced the strip ratio. They've been able to get that mine to full production. They just announced full production. They'll be producing between 55 and 65,000 ounces a year. If I know Arturo, that'll be conservative. And their margins are a healthy 650 to 700 an ounce right now, with the strip ratio coming down, meaning they're going to have higher margins in the near term. So when I look at Magna Gold and I see a market cap of $80 million roughly US, and I see that they're going to be producing 55 to 65,000 ounces of gold this year, and I do the math and I see how much of that is going to be profit, I think my lucky stars I could buy it at an $80 million valuation. It's great. It's frustrating for subscribers that saw it go to 170 and then pull back during the most recent consolidation. But I'm not buying companies right now to sell them a month or two down the road. I'm buying companies for the next couple of years, right? And so Magna Gold is one that I would say if gold doesn't go up another dollar, it's going to do phenomenally well.
Well, that's good to know. I'm not following that one. So I'm making a note now to take a look at it. Anything else you'd like to share?
I really like copper. I've been a copper bull since 2016. I think that I'm a contrarian by nature, Brian, so I'll caution this one is, earlier stage, but higher risk, higher reward. But they also have a significant joint venture with JOGMEC, which is, the oil and gas and mining division of the Japanese government. And so they just signed, the company's name is Hanon Metals. And this is a basin scale play. And this is important. This isn't a district scale play with the potential for multiple deposits. It's a basin scale play with the potential of multiple company makers. And I think that the $35 million joint venture that was just recently announced by Hanon a few months back on a third of those land holdings in Peru, which just went through some election turbulence, right? That I think is getting settled. With the market cap where it is today, it makes for a phenomenal speculation. Unfortunately, we won't see drill results until the first quarter of 2022, but it's for the right reasons. They're doing all the right early stage exploration work across this basin to make sure that they're drilling the best targets. And I think, again, at current market cap, that's a phenomenal speculation for anyone that wants exposure to a high risk, high reward, though anchored by a 35 million US joint venture to explore a third of their land holdings, and a junior that has somehow figured out how to become a top 10 landholder in Peru, with every other company on that list having a market cap in the billions of dollars. So Hanon Metals, that's a great copper, gold, and silver pick. They actually have very high grade copper, gold, and silver showings across hundreds of kilometers.
Yeah,
well, that sounds great.
What you say, Gerardo, how you almost de-emphasize so much focus on the price and more just on company-specific research. Is this a trend you've developed over the years to try to not get too tied up in price fluctuations?
The few times that I've been very, very lucky have come as a result of that, right? It's rarely come as a result of a mega trend where I bought at just the right moment because of the trend. Though that did happen in 2010 with rare earths. And I was lucky enough to have a mentor and a friend that kind of educated me to that back then. But it's usually come from making sure that I'm investing and speculating in companies that have catalysts outside of the trend. Now, if the trend comes in and is your friend, that's phenomenal. I think we have a uranium trend that will be our friend for years. I think we have a lithium trend that'll be our friend for years. I think we have a copper trend that'll be our friend for years. But I don't want to rely on that, because my success really has come from buying things that nobody wants, that make perfect sense and are obvious to me at the time. And it just takes a little bit usually for things to catch up. Don't get them all right. No one does. Anyone that tells you they do is lying to you. But you give yourself a better shot on goal if you're actually able to identify the specific catalysts that are going to add value independent of a higher commodity price.
Right. Well, we've raced through half an hour. Your websites are Digest Publishing and Resource Stock Digest. You are active on Twitter. And now it's, I think, RS Digest. And so Digest Publishing, and you also are involved with Daily Profit Cycles. So you've got a lot of action going on. We'll have all those links in the show notes. It's goldnewsletter.com/podcast. Gerardo, is there anything just you're itching to get out before we let you go? Other than we're going to see you in New Orleans soon.
I can't wait to see you all in New Orleans. I'm very thankful for the opportunity to speak again. I want to thank you again for the time today. I would encourage anyone out there that has seen the 30 to 50% pullback in the juniors here over the last several months to use that pullback to your advantage and really focus on companies that are adding value via the drill bit, via joint ventures, whatever that is, whatever that catalyst is. And reach out. I am active on Twitter. I try to respond to every email I get. Please reach out, and happy to have a conversation with anybody that wants to.
Perfect. Thank you, Gerardo.
Thank you, Gerardo. We could have gone for another half hour or hour even, but thank you. You also touched on a couple of companies that we're not covering in Gold Newsletter, so that's special value for our listeners right there. So thanks again, and we'll see you in New Orleans.
See you in New Orleans, Brian. Fergus, thank you so much. Appreciate it.
Cheers.